Hi, this is Phil Chandler. Today we're talking about the different forms of entities there are out there that business owners can choose when they're trying to figure out what kind of organization, what kind of entity do they want to be for the business that they're looking at creating. So probably a week goes by that I don't get questions from either somebody calling me during tax season or during the rest of the year where they're saying, I want to create a new business. What do I need to be? And the answer is, it depends. Unfortunately, there's not a clear answer. But I thought it would be a good idea for us just to kind of step through the basic types of entities that there are out there. So we can kind of just talk about the pros and cons for each one that might help you make that decision. I always encourage you to reach out to an accountant, a CPA like myself, to maybe help you step through that process. But this will kind of step you through some of the basic parameters of it. So the first one, let's talk about what is out there. What kind of entities can you create? And I list them here. There's 5, and really there's 4, but we'll talk about that. So the first one, sole proprietors. Second one, partnerships, which is more than one person owning it. Then there's a couple of different forms of corporations, a C corporation and an S corporation. And then there's the entity called an LLC, a limited liability company. And that really is not an entity in itself, but it's a way of creating an entity. And we'll talk about that in a little bit. So let's dive into the first one, and the simplest one, sole proprietors. So, actually when somebody decides to start doing some form of business, in other words, when they sell a product. They sell pencils. The day they sell that first pencil, they've automatically created a sole proprietor. So as a sole proprietor, you don't really have to do any paperwork. Just by the nature of you doing some kind of business operations, you're selling a service, you're selling a business. As soon as you decide that you're going to be in business, you are in business. But what you've done is you've created a sole proprietor. So there's no formal process that you have to go through really with the IRS or with the state to create a sole proprietor. And that doesn't mean that you don't need to go get a business license with the local county or city officials. But just in the general sense, sole proprietors means that you're working for yourself, that there's no other partners, and that you're a very simple process. So let's talk about maybe some of the pros. Well, first off, as I just mentioned, it's very easy to set up. You just start doing business and you're a sole proprietor. Now, only one owner is in fully control. It's you. A sole proprietor means by nature there's only one owner, and that's you. So that could be a pro. You don't have to deal with any partners or answer to anybody else. And the profits are reported on your personal tax return. So it goes on what's called a Schedule C, which is just a form, an attachment that goes with your personal tax return. So it keeps it very simple. There's no special tax return you have to have. And I'm in Tennessee, so like in Tennessee, we don't have a state income tax, but we do have a business tax, and it's called a franchise and excise tax. But in the case of a sole proprietor, they don't have to do that either. So, and that's the case for a lot of other states where sole proprietors are by nature considered small entities, small business owners. So they give them a little bit of leeway as far as the documents that they have to comply with. Now, there are some cons, some disadvantages. So the owner is fully liable for the business. So the business is you, you are the business. So there is nobody else to answer to. So you are at full risk. And unfortunately, when you die as a sole proprietor, the business dies with you. In other words, the business only exists because you exist. Now, that doesn't mean that you can't figure out a way through trust or through some other type of formal process that sole proprietor can't be immediately passed to somebody else. But that's not a straightforward process. So typical rule of thumb is a sole proprietor only exists as long as the person who is the business owner exists or lives. And the other disadvantage that I mentioned in here is capital is mainly provided by the owner. In other words, banks, if you're trying to borrow money from a bank, Well, if you're the sole proprietor, you're not really borrowing the money in the name of the business. You're still borrowing the name in your personal name. So it's not necessarily a disadvantage, but you're kind of limited as far as where funds can come from. In other words, you can't get them from another investor because a sole proprietor, there's only one owner, and that's you. And there's no stocks, and there's no membership. So basically, it does limit you to a certain extent on raising funds from other sources beyond yourself, which is your personal bank account. All right, let's dive into the next one. The next one's partnerships. So probably no big surprise, if you're a sole proprietor and you want to bring on another partner or another owner, you automatically create a partnership. Partnership means there's more than one owner, 2 or more owners, could be unlimited number. And really, when you say partnerships, there's technically 2 types of partnerships, a general partnership and a limited partnership. We'll talk about that in a minute, but basically partnerships is the next phase. So the pros, let's say the advantages of a partnership. One is more partners means more sources of money. Obviously, that's one reason why a lot of people say, all right, I need a partner, is because he's got deep pockets and my pockets aren't so deep. So it would be great to bring on a partner where we can kind of pool our resources as far as capitals. Partners are the profits for a partnership are reported on the individual tax returns, which keeps that simple. Profits are considered self-employment income. So let's talk about that in a minute. So just like a sole proprietor, the profits for a sole proprietorship show up on that owner's personal tax return. And partnerships is the same way. A partnership does not pay federal income tax typically. What happens on that is that the partnership reports a tax return to the IRS, called a Form 1065. But the actual profits coming out of that partnership get split to the partners on whatever percentage they've agreed to. And then those profits are reported on the personal income tax returns. So that's kind of a benefit in the sense of the taxes that you pay on your share of those profits is solely dependent on what your tax bracket is and what your individual tax return looks like. Limited partners, now I said there's general partners and limited partners. So a limited partnerships means that you're not exposed to the risk of the business in the sense of any more than how much money you put into it. So a lot of people consider that a silent partner. So let's say you want to invest into a partnership. So you want to be one of the owners, but you're not part of the management team. So let's say you put in $50,000 into that partnership. Well, as a limited partner, you're not exposed to risk that the business might be running into or the decisions that might be made by whoever manages that business, the managing partner. So if you put $50,000 into the business, yes, you can lose your $50,000, but that's pretty much it. Now, in a general partnership, and we'll talk about that just a little bit, that's the disadvantage of a general partnership, because everybody in a general partnership is considered a managing partner, is considered that general partnership. So decisions made by you, obviously you're at risk for those decisions, but in addition to that, you're at risk for the decisions made by the other partners. You've all pooled your resources, you're all saying you're all managing partners, which means you're at risk for whatever decisions made by the other partners. That's why general partnerships, for the most case, is not as popular, not as common anymore than the limited partnership, simply because there's a limited exposure to, in a limited partnership, if you're one of those partners, you're only exposed to limitations on decisions you've made and not on decisions made by the other partners. So the cons, the disadvantages is what I was just talking about. General partners are exposed to the risk of the business decisions made by all the partners. So I don't really recommend a general partnership. There are a few cases where it makes sense, but for the most case, if you want to be a partnership, you want to be a limited partnership. All right, so the next thing we jump into the corporations. As I mentioned before, there's two types of corporations, a C corporation and an S corporation. I'm mainly talking to and dealing with small businesses. Now, small businesses, we're talking millions and millions of dollars. So just because I'm saying small business does not mean that it's a really small business. But typically, right now, we're talking about C corporations. C corporations, first off, the basics. It's a formal and a regulated type of entity. So if you're looking at public companies that are dealing on the stock exchange, you're dealing with a C corporation. There are some small businesses that it does make sense to be a C corporation, but for the most case, it's not. And I'll explain that to you in a little bit. So the pros of a C corporation, the advantages, there's an unlimited number of shareholders. So yeah, if you want 1,000 shareholders to try to help raise money, C corporation is what you want to do. There's no limit on types of shares. There could be common shares, there could be preferred shares, there could be a number of different types of even those components. So you can make it very complicated as far as the ownership, the shares, and all that kind of stuff. And obviously one of the big advantages of a C corporation is the shares can easily be sold to raise money. That's one of the benefits. Now you can do that in an S corporation also. But that's the main advantages. Disadvantages of a C corporation, well, the big one that everybody hears about and talks about is its double taxation. And what that means is, in a C corporation, unlike what I talked about a partnership or a sole proprietor, those businesses aren't taxed themselves. The individuals are taxed. In a C corporation, that entity is taxed. So it does a tax return called 1120. And it does pay taxes to the IRS. But let's say there's the income, the net income that business makes. First off, it pays taxes to the IRS. But when the owners, the people that own the shares, want to take their share of those profits out of the business, they also pay taxes, and that's called dividends. So when the dividends are taken out, the profits are taken out to the individuals who own that company, they're also taxed. So that's where the double taxation comes in. That's why for small businesses, that's not really the preferred standard. Where C corporations, for the larger companies, publicly traded, they don't have a choice. They need to do that, and they just have to suck it up and figure out the double taxation's part of the business, part of the cost of doing that business in a C corporation. There is some required formal reporting on it. And of course, the government's got higher regulations requirements, which is good. C corporations, especially if the ones that are formally traded on the stock exchange, obviously we all want to make sure that there's rules and regulations. So if we're buying shares of something, we want to make sure somebody's paying attention to that company, that they're doing it right, that whatever they're reporting to the government is correct. So that's why the government steps in, and they've got all kinds of rules and regulations. The next one I want to talk about, the other type of corporation, is an S corporation. This is the one that's more popular with small businesses, and for a couple of reasons. Basically, it does allow up to 100 shareholders, so it's not like you can only have 1 or 2 or 3. So by no means does it limit you to a large extent on the number of shareholders. It does limit you to 100, but that, in my opinion, I very seldom see an S corporation that even comes close to that many shareholders. So the benefits, the pros of a S corporation, first off, just like a C corporation, it makes it easy to raise money. So if you're looking you don't want to go to the banks and you're tapped out, so you don't want to put any more money personally into it, selling shares of stock is a good way of raising money, without a doubt. And this next one I do get some disagreement with, but in my opinion, from dealing with lots and lots of banks trying to loan money or trying to work with small companies, banks typically perceive an S corporation as more stable, and they're more willing to lend money to those businesses. And I'm talking about that in comparison to possibly a sole proprietor. Is there a good reason for that? Not necessarily, but except in the sense that part of it's just perception by bankers. The other part is an S corporation does have some type of formal structure to it. So I think bankers perceived if somebody's gone through the process of setting up an S corporation and are complying with some of the bylaws and regulations to have a corporation, they're perceiving that that guy's not a small-time player, that at least he's stepping up to a level of having a business entity and a corporation that makes sure that at least the guy's taking care of business. It's easy to spread out ownership and risk. That's definitely a pro. That's definitely an advantage. And the profits are passed to stockholders for reporting of taxes. So let me explain what that means. S corporations reports their income to the IRS just like a C corporation. They do that on a 1120S tax return, but they don't pay taxes to the IRS. So an S corporation is really just like a partnership in the sense that all the profits are reported to the individuals who own shares in that business. And then those profits are taxed on the individual's personal tax return. It's called a pass-through entity. And that's pretty important, and that's one of the benefits that an S corporation has, in my opinion, and that's why a lot of people like to be an S corporation. But in addition to that, an S corporation, let's say whoever these shareholders are that are actually managing or running the business, they can be paid. In fact, they're required to be paid a salary, and then all the remaining distributions are show up as profits to the individuals on their personal tax return. So let me explain that a little bit further. If you're a partnership, partners in a partnership are not an employee. So they can't pay themselves. They're not allowed to pay themselves a paycheck. All the money that they take out of that is called distributions. Where an S corporation, actually it's a requirement that whoever the managing shareholders are, the ones actually running the company, have to pay themselves a paycheck. And then the rest of it they take out in distributions. And here's the reason why they do that. Because when you get a paycheck as a managing shareholder in an S corporation, you're just like any other paycheck. It takes out federal withholding, Social Security, and Medicare. So taxes are taken out beforehand. But what's left over, the profits that are left over in the distribution, they're not considered self-employment income. So you only have to pay the federal withholding. So there's a lower tax bracket, a lower tax on the distributions than there are on the paycheck. So the next question is, well, why don't I just pay myself a nominal amount of a paycheck and take everything in a distribution? And I get that conversation quite a bit. And the answer is the IRS pays attention to that. They fully know what's going on. So what they say is to the managing shareholders is you have to pay yourself a fair wage. There's no chart that you can look at. There's no IRS publication that says this is a fair wage. So there has to be some attention made to that. And the premise basically is that if the managing shareholder decided not to be managing or not to be working day in and day out to that business, with that business, how much would you have to pay somebody else to manage that operation? Obviously, you're not paying that guy $10,000 a year, so you have to pay yourself a fair wage as if you were paying somebody else to run that business. So that kind of sets the parameter, the basic conversation on what is a fair wage. And I usually have some, it depends on the type of industry, it depends on what you're doing, it depends on whether there's any other employees or if it's you just generating all the income. So there are some basic parameters that you look at. But the point being to this whole thing is that the managing shareholder pays himself a paycheck, a fair paycheck, and he has to pay Social Security, Medicare, federal withholding. Everything else is a distribution, and that's at a lower tax bracket. So that's one reason why a lot of people like an S corporation versus, let's say, a partnership. Okay? The disadvantages, one, that there's only one class of stock allowed. In other words, a C corporation, as I mentioned before, you can do a common stock, preferred stock, and all different types of forms of those preferred stocks. But S corporation, only one class of stock. That's usually not a big deal for small businesses. Corporations do have more regulations. Now, granted, An S corporation is not quite as formal as a C corporation. It's not going to be publicly traded probably. And one other disadvantage is there are some setup fees and involvements as far as you have to create an article of incorporation, some bylaws, you have to issue stock certificate, maybe not formally, but you would want to have a board of directors and at least meet once or twice a year. But that could simply be going to dinner, having a conversation about how's the business doing, how's it going to do. You put that on some documents saying, all right, we've formalized a board of directors meeting for this year. Let's move on. So it doesn't have to be a big involved process, but there are processes that the government says you need to follow to be a corporation, whether a C corporation or an S corporation. All right, and then the last entity that I talked about is an LLC. This gets a lot of publicity. A lot of people automatically ask me about creating an LLC. And what's interesting is LLC, first off, stands for Limited Liability Company. And this is set up with the state, whatever state that you choose to set up your LLC. What I typically recommend is set the LLC up in the state that you live in and possibly operate your business in. Don't try to make it any more complicated than it has to be. I know there's some discussion about setting it up in one of the other states that allows you to either shield yourself as far as who owns the business, and that's possible. Or if you're trying to hide assets or you're trying to hide profits so somebody can't find you. And I'm not talking about that in an illegal fashion, just because there might be reasons, legal reasons, why you don't want people to easily find out who owns and who's getting the profits for it. But for the most part, most LLCs, if somebody's going to create one, I say put it in the state that you live in and put it in the state that you operate your business in. But what's interesting is an LLC is not recognized by the LLC. That's not by the IRS. That's not a formal entity in the eyes of the IRS. So what you do is you create an LLC in whatever state you choose. But then at that point, you choose how that entity is going to be recognized by the IRS. So here's 3 examples. One is if it's a single member LLC, in other words, only one person owns it. So you're creating an LLC in the state, and you're telling the state that I only have one member. So in the eyes of the IRS, that's called what's called a disregarded entity, which means it's treated just like a sole proprietor. So it's a Schedule C on your personal tax return. The only difference is instead of it being a sole proprietor, it's an LLC, single member LLC. If there's more than one person owning that LLC, then it automatically means you've created a partnership. So in the eyes of the IRS, you've got a partnership. That partnership files a 1065 tax return, does not pay taxes. Those taxes flow through to the individuals that own them, the members that own that one. So that's the other option. But you could also choose, instead of a partnership, you could say, we want to be a corporation. Now you can decide to be a C corporation or an S corporation. And there's a piece of paper that you file with the IRS that basically says, we've got an LLC, we want to be recognized as a C corporation or an S corporation. So that's how that works. An LLC by itself does not really tell you what kind of entity you're going to be treated like in the eyes of the IRS. You're either going to be a sole proprietor, treated like a sole proprietor, single member, or a partnership, or an S corporation, or a C corporation. So LLCs are very popular, and that's one reason why. They're very flexible, and you can choose on how you want that LLC to be treated. So let's talk about the advantages. First, it's fairly easy to set up. You only have to do it with your state that you choose, and there's some paperwork to file, a few fees, not a big deal. And you can change the stripes. In other words, sole proprietor, partnership, or corporation, S or a C corporation. A little bit of the disadvantage might be there's some confusion. In other words, with the state and the IRS on what type of entity you are, they don't really care, in my opinion. Most of the time that creates a confusion if you're dealing with people in your state, let's say a bank. They ask you what kind of entity. You're an LLC. Well, You're an LLC in the state, but you're an S corporation in the eyes of IRS. So that's not a big downside, but it just does sometimes cause confusion. If somebody calls me and says, I want you to do my taxes, I'm an LLC, that doesn't really tell me what they are. It just says that's how they were created. So, in conclusion, what's the best type of entity for you? I know it's not a great answer, but it depends. So, next thing you need to do is do a little research, reach out to a CPA such as myself, and we can help you through it. Take care.